Welcome to Introduction to Accounting, lesson number 3. Here we cover chapter 5 only. In chapter 5, we introduce inventory accounting for the manufacturing and merchandising business models. We will introduce and discuss 4 cost flow methods that are allowed under the generally accepted accounting procedures. Although the firm has a choice of methods, once a choice has been made, the firm is not allowed to change to a different method without substantial reason. The cost flow method chosen has a large effect on gross margins reported in the income statement. To begin with, the 4 cost flow methods are specific identification. That is, we identify each single product as it passes through. This would be a large product like an airplane or a house or building, okay, typically. The second is first in, first out. Then we have last in, first out, and finally weighted average. The actual physical flow of goods may not match the accounting method chosen. Generally, first in, first out is the way products move through a merchandising firm. That is, the earliest merchandise is purchased is sold first, and the later merchandise sold later, but this is not always the case. An example of last in, first out would be a gravel pile. We put on the gravel as we pour it on. The last gravel lands on top, and that would be the first gravel scooped up and sold because the gravel down at the bottom, the first gravel is just not accessible. So that's a last in, first out system. We could also talk about a gasoline station which sells gasoline, and there probably a weighted average cost would be appropriate because the gasoline is being added continuously from the truck, and the question is, which gas are we selling? Well, it's mixed, so a weighted average approach could be used. An example. Since inventories often consist of identical goods purchased at different prices, we need a system to calculate the cost of goods sold and to calculate the gross margin generated by each sale. We find that the last purchase of inventory usually costs more than that purchased earlier. This is because the environment is generally one of rising prices. We call this inflation. The opposite would be a deflationary environment characterized by generally falling prices. Under the more common inflationary scenario, FIFO will show a lower cost of goods sold than a LIFO system. This is because we are counting the older, cheaper products first and the newer, higher priced goods after the earlier units have been used up. This has the effect of increasing income reported, which in turn triggers higher current taxes. LIFO, last in, first out, has the effect of reducing income and therefore taxes in the current accounting period. Note that taxes are not actually reduced, just delayed. Still, the temporary tax saving can be quite large and works just like a free loan of funds that can be used for working capital until the taxes become due at a later period. To really understand the difference, answer the Check Yourself problem 5.2 found on page 256 in the yellow and green highlighted box. And this will give you a nice numerical example so you can see what actually happens. We generally contrast FIFO and LIFO methods since they show the greatest differences. The weighted average method will show a cost that is between those two extremes. The specific units method is neutral since we are tracking a single item only and assigning all costs directly to it. Note that using LIFO or weighted average methods can cause timing problems that are partially overcome by using a perpetual inventory system as opposed to a periodic system. This is an advanced discussion that is somewhat beyond the scope of this course, and so we will mercifully pass it by. Final inventories are reported at either historical cost or actual market value, whichever is lower. Any losses due to damage, deterioration, obsolescence, theft, or price deflation is recognized during the current period. Inventory accounting presents an opportunity for fraud. The accounting system includes a number of tools and controls that help reduce this possibility. The authors discuss some of these practices on page 251, 252. A fuller treatment of fraud is presented in the auditing classes that are taught here at IAU. The Check Yourself Problem 5.3 on page 263 shows how a difference between physical count and estimated count can be ignored because it is not material. Materiality means of enough significance to actually matter. We close with a discussion of the effects of gross margins and inventory turnover rates on profits. Note that there are two inputs here: the margin, the amount of money made per sale, and turnover, the number of sales made in a given time period. This analysis can be very useful in measuring the relative stability and efficiency of different firms that occupy the same industry. The discussion questions are a little longer, but there are only 2 sets, so the homework is about the same as you would for 2 chapters. The remaining lessons will cover sometimes 2, sometimes 1 chapter for reading and problem solving. Note that next week we will be halfway through our course, and you want to make sure that you're keeping up with all the work. Feel free to bring in any of the issues that you have for discussion during class of previous discussion question lessons. Thanks so much. See you this week.